And today's biggest mover would be HDFC Bank after it announced its quarterly results, which reflected a 2.3% of a year-on-year rise in its consolidated net profit to 17,657 crore. My colleague Harsh is waiting to break down the numbers for us. Harsh, what are you making of HDFC Bank numbers? And also, what are the brokerages saying about the results?
Well, yes, let me first start off with the numbers themselves. Saw a spike in the stock price yesterday on the back of these numbers. It was a steady, strong set overall. You're looking at an inline set with regard to both net interest income, operating profit, as well as profit after tax. The provisions in a tough quarter have been absolutely stable. They've come largely in line, slightly off a low base. So it was at 2,700 crore at the end of Q2. It's spiked up a little bit to 3,150 crore, but that's also because of agri, is what the management said. Ex-agri, everything remains as is. Your PCR, which is your provisioning coverage ratio, is healthy at 71%, ex-agri again. And you're seeing credit costs at 50 basis points, which is 0.5%, which is excellent, given the way some of the peers in terms of credit and asset quality have behaved. So that's the key portion there. Where real management commentary comes into play is when growth will come back. FY25, they believe, is a year where growth will be below industry. FY26 will be, HDFC Bank will grow at industry rate. And FY27, they expected an outperformance, or they've guided for an outperformance versus industry where growth is concerned. Now, this is a key metric because it will also hint at expansion both of EPS and when EPS will expand, and when HDFC actually sees itself normalize in terms of loan to deposit ratio and therefore growth. Now, in terms of what brokerages are making of this, it's interesting. First off, Bernstein believes that a healthy set of numbers were reported. The numbers as well as the commentary largely ticked all the right boxes, is what they say, quote unquote. Now, no signs of asset quality stress, which plagues many peers, which is a positive. OPEX growth subdued, likely to stay that way. And margins are within a tight range despite many headwinds, is what they're saying. They're expecting the bank to return to mid-teens EPS growth by FY26. That's Bernstein for you. Daulat, they also suggest that our inline profit metrics, sequentially stable margin, credit costs at 50 bips and slippages at 1.4% were largely in line. In fact, better than peers, even though in line with estimates. They've tweaked their earnings, factoring in a lower growth and slightly improved OPEX. They've given it a target price of 1,950, which is a 19% upside, and they're looking for improvement in businesses, including the growth drivers of businesses. Last off, you have Citi, which is extremely bullish, 2,080 being the target price, 24% upside from here. They also very constructive with regard to the way they are looking at the numbers, and they continue to maintain their buy rating without any meaningful change in earnings estimates. They've largely retained earnings estimates and they've maintained their buy rating.